Home values are ultimately set by what monthly payments people can afford. You can list it at $1.2 million, but you can only rent it for reality. In the housing market, nominal prices are flexible, but affordability is not. The true value of a home is anchored to the monthly payment buyers can sustain. That payment is shaped by three forces: interest rates, income, and credit conditions. When prices drift beyond that constraint, the market does not argue. It adjusts through stalled transactions, through silent price cuts, through rental yields that quietly reveal what the property is actually worth. Section 1, Introduction. The illusion of price versus the reality of payment. There is a quiet contradiction sitting at the heart of today's housing market. On one side, you have sellers listing homes at $1.2 million, anchored to past sales, anchored to appreciation, anchored to belief. On the other side, you have those same homes failing to sell and quietly being offered for rent at $4,000 per month. That second number is the tell. Because unlike listing prices, which can be aspirational, sticky, or even delusional, rent operates under immediate discipline. A property that is overpriced does not get rented. It sits empty. There is no narrative to hide behind. No, we will wait for the right buyer. The market either clears or it does not. And this is where the illusion begins to break. A $1.2 million home at current interest rates implies a monthly mortgage payment far beyond what most households can sustain, often in the range of $7,000 or more. And yet, that same property only commands $4,000 in rent, which tells you something critical. The market does not support the payment required to justify the asking price. And in housing, payment is everything. Section 2, the mechanics of affordability. At its core, housing is not priced in dollars. It is priced in monthly payments. When a buyer evaluates a home, they are not asking, can I afford $1.2 million? They are asking, can I afford the monthly cost of owning this home? That cost is determined by three variables: interest rates, loan duration, and borrowing capacity. Together, these define what we can call the payment ceiling, the maximum monthly outflow a household can sustain. Once that ceiling is reached, the system stops. It does not matter what the seller believes. It does not matter what the home sold for last year. The constraint is binding. To illustrate, at roughly 6 to 6.5% mortgage rates, a $4,000 monthly payment supports a loan in the range of approximately $600,000 to $670,000. That is the mathematical reality embedded in the structure of amortized debt, which leads to a powerful implication. If the average buyer can only afford a $4,000 payment, then the effective market value of homes is anchored to what that payment can finance, not what sellers wish to receive. This is the hidden gravity of the housing market. Prices can stretch, narratives can inflate, comparables can drift, but the payment ceiling remains. Section 3, Rent as a market signal. If mortgage payments represent the potential cost of ownership, rent represents the realized cost of shelter. And unlike sale prices, rent adjusts quickly. This is why rental markets act as a truth mechanism. When a property fails to sell and is instead offered for rent, the owner enters a different market, a stricter one. Tenants do not speculate. Tenants do not rely on leverage. Tenants pay based on affordability and alternatives. So rent reflects what people can actually pay today, not what they hope to justify tomorrow. And when a $1.2 million home rents for $4,000, it is doing something subtle but profound. It is revealing the cash flow equivalent value of the asset. It is answering a simple question: what is this property worth to someone who must pay for it out of monthly income? And the answer in this case is not $1.2 million. It is whatever asset value corresponds to a $4,000 monthly payment. This is why rent can be seen as price discovery. It bypasses inertia, optimism, and illusion. It strips away narrative and exposes constraint. Section 4, the role of interest rates. If monthly payment is the anchor, then interest rates are the lever. They determine how much house a given payment can buy. When rates fall, affordability expands. When rates rise, affordability contracts. The effect is mechanical, immediate, and powerful. Consider the same $4,000 monthly budget. At roughly 3% interest, conditions seen in 2020 and 2021, that payment could support a loan. approaching $900,000 or more. At roughly 6 to 6.5% current conditions, that same payment supports only $600,000 to $670,000. Nothing about the buyer changed, nothing about the house changed, only the cost of money changed. And yet, purchasing power collapsed. This is why housing markets are not just about supply and demand. They are financial systems governed by credit conditions. During periods of ultra-low rates, buyers are handed leverage. They can bid higher, stretch further, justify elevated prices. Not because homes are more valuable, but because financing makes them appear affordable. That is how price inflation enters the system. But when rates rise, the illusion reverses. Buyers qualify for less. Monthly payments increase, demand weakens at higher price points, and the market meets a constraint it cannot escape. The payment ceiling returns. This is why housing corrections do not begin with price crashes. They begin with affordability compression. Transactions slow, listings linger, sellers hesitate. But beneath the surface, the math has already changed. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Monetary policy and the debasement effect. To understand how prices reach these levels, you have to zoom out. Over the past 2 decades, monetary policy has shaped asset markets, especially housing. After the financial crisis, central banks introduced near-zero interest rates, quantitative easing, and large-scale asset purchases. This was not neutral. It injected liquidity and lowered the cost of borrowing. Capital flowed into assets. Real estate became a primary destination. Because in a world where currency yields little and inflation rises, investors seek stores of value, assets that preserve purchasing power. Housing fits that profile. It is scarce, it is leveraged, it produces income, and it benefits directly from lower rates. This is what many call the debasement trade. As money becomes cheaper and more abundant, asset prices rise. Not always because of fundamentals, but because liquidity must go somewhere. Over time, a divergence forms. Asset prices rise, incomes lag, the gap widens. Those who own assets see their wealth expand. Those who do not face higher barriers. Housing becomes more than shelter. It becomes a financial instrument. And once that dynamic begins, it reinforces itself. Rising prices attract capital. Capital pushes prices higher. Higher prices justify further investment. Until something breaks, or more precisely, until affordability pushes back. Section 6. Structural constraints amplifying the problem. Monetary policy may light the fire, but structure determines the outcome. In a flexible market, supply would rise with demand. Prices would stabilize. But housing is not flexible. Supply is constrained on multiple fronts. After the financial crisis, construction slowed dramatically. For years, new supply lagged population growth. A deficit formed, millions of homes short. Then there are zoning restrictions, limits on density, limits on height, long approval processes, barriers that prevent rapid expansion. Add to this local resistance to development. Projects delayed, projects canceled, supply constrained further. At the same time, demand increased. Large demographic groups entering peak buying years. More households chasing limited inventory. And then a new force entered, institutional capital, private equity, large-scale landlords, homes becoming assets, yield-producing instruments, portfolio allocations, not just places to live. The result is a critical imbalance. Supply cannot respond fast enough. So when demand increases, prices do not stabilize, they rise. And when cheap money enters the system, it does not create more homes. It creates higher prices. This is why monetary policy has such a strong effect on housing. Not just because demand increases, but because supply cannot adjust. Section 7. The affordability gap. What follows is a widening gap at the center of the housing market. On one side, home prices elevated by years of cheap credit and constrained supply. On the other, incomes growing far more slowly, buyers constrained by higher rates and tighter affordability. This creates a mismatch. The median household cannot afford the median home. And when that happens, the market fragments. A smaller pool of buyers remains. Dual-income households, high earners, existing owners rolling equity forward, while first-time buyers are pushed out, delayed, priced out entirely. This is the affordability gap, not simply expensive housing, but a broken relationship between price and income. And when that relationship breaks, markets do not clear smoothly, they stall. Section 8, market adjustments and outcomes. Housing markets do not move like stock markets. They move slowly, unevenly, indirectly. When affordability is strained, adjustment happens in stages. First, transactions decline, buyers step back, sellers hold firm. The market freezes before it falls. Then listings become sticky. Prices do not adjust quickly. Homes sit longer, discovery slows. Then owners pivot, they rent, and reality enters because rent must clear the market. And in doing so, it often reveals a lower value. Over time, prices may adjust, slowly, or in real terms, through inflation. There are two broad paths: a slow adjustment, prices stagnate, inflation erodes value, affordability improves gradually, or a hard reset, forced selling increases, prices fall more sharply, the market clears faster. In many cases today, the slow adjustment dominates. Time does the work. Section 9. Heuristics and frameworks. To navigate this complexity, participants rely on heuristics. Simple frameworks, approximations of value, price-to-rent ratios, comparing home price to annual rent. High ratios suggest prices are elevated. Affordability ratios, housing costs as a share of income, defining practical limits of demand. Investor rules, 1% rule, 50% rule, estimating cash flow and viability. Each framework attempts to answer the same question: what can people actually pay? And despite their differences, they converge on one constraint: monthly payment capacity. Section 10, broader implications. Housing is not just a market, it is a mirror, reflecting the structure of the economy: monetary policy, income distribution, access to credit, institutional behavior. When housing becomes unaffordable, it signals imbalance. A divide emerges between asset owners and income earners. As prices rise faster than wages, ownership becomes a gatekeeper to wealth, to opportunity, to mobility. The implications are generational. Older cohorts benefit, younger cohorts struggle to enter. Housing becomes a sorting mechanism, not just shelter, but access. Section 11. Conclusion: the immutable constraint. Strip away the narratives, strip away the listings, strip away the comparables, and one principle remains: prices can stretch, affordability cannot. The housing market clears where monthly payments meet what buyers can sustain, not what sellers hope for. Not what the last sale suggests, not what the asset once commanded, but what the next buyer can finance, month by month. This is why rent matters. It operates in the present, it reflects real constraints. And in doing so, it reveals something fundamental. The true price of housing is not what it is listed for. It is what it costs to carry. Everything else is negotiable.